Okay, so welcome to our last panel, and thank you guys for hanging with us all day long. Really appreciate it. I think this is going to be quite an exciting lineup. Our topic is success as a public company, and in order to get my revenge on JC for getting me into this thing in the first place, he's going to be moderating it, so that's his penance for coming up with this idea. But we have some great speakers here. So Eddie Wong is a senior partner at MarcumAsia, extremely experienced auditor, and I think has been traveling around Southeast Asia almost as much as I have in the last 4 or 5 months. So has definitely a perspective on the region. Then we have Alex Jin. Alex is very seasoned. His firm Maxim is very seasoned, both in terms of SPAC IPO issuance, traditional small cap IPOs of operating companies, and then working with de-SPACs as well. And more importantly, working with companies to be able to take advantage of the U.S. markets and be successful over the long term, which is really our topic for this panel. Next to him, we have Hiren Krishnani. So Hiren, for those of you who haven't met him yet, is the head of NASDAQ listings here in Southeast Asia, domiciled based here in Singapore. So we're glad to, obviously, NASDAQ has had a lot of success attracting listings from the region, and I know, we have at least a dozen more names that will be heading to NASDAQ over the next few months, so excited about that. Mitch, you already know if you were here this morning, so I don't think I need to reintroduce him, except to one of the most senior legal practitioners in the SPAC and de-SPAC field. And finally, Tony Tian of U.S. Tiger Securities, very active in cross-border listings from Asia. So great panel, and I'm going to turn it over to JC to take it away. Thank you, guys.
Thank you, Crocker. It has been quite a ride over 5 months to get this thing organized, and really a lot of kudos to Marcum and Mitch and all the senior people here at the team to have made this possible. Those who have flown out from New York, just to attend this and participate at this SPAC conference. So, thanks again. So the title actually is a success as a public company, but it's really got nothing to do with me yet. We're Aetherium Acquisition Corp. We're actually a SPAC sponsor and a SPAC. The first time SPAC. And if this goes well, hopefully it'll lead to a series of other SPACs as well that we intend to do. But I've got an expert panel here with me, and I want to get through this as quick as we can. So I've scripted up some pretty granular questions, and let's get into it. So Alex, Maxim. Maxim has been one of the really active in terms of the underwriting of SPAC IPOs, and then financial advisors to the de-SPACs as well. So what's the state of the current pipe market that you see today? And then what kind of deals has been successful? And then I guess then the third question would be, what are the profile of the investors that have been participating in the pipes?
Yeah, I would say, obviously the broader capital markets has been very volatile, but in spite of that, the deals are still getting done. Year to date, there's about $600 million worth of pipe that has completed, which represented a sharp decline compared to the same period back in 2011, 2021, and 2022. So I would say the overall deal volume and the size of the deal have calmed down quite a bit compared to the peak of the market cycle. So from investors' standpoint, they're being more selective in deploying capital. So they're focusing more on the track record of the sponsor. They're looking at merits of the deal in terms of valuation, growth prospect, etc. And I guess in terms of the type of investors, I would say there are different pockets of capitalists out there. You have the typical hedge fund universe, but in addition, you also have within the specific division of a larger credit fund, those type of investors also interested in playing live market.
So nothing really has changed in terms of the investor base, right? They remain relatively the same.
Yeah, I would say so.
Mitch, so full disclosure, Mitch is also my legal counsel. And bar none, he is the best by a country mile for the SPAC ecosystem. And everybody should use him, right? That reduces my legal fees. So when you act as legal counsel for a target company, are there any particular structures or types of investors that you would advise your clients to kind of stay clear of?
Stay clear of or to look for? Maybe I'll hit them both. I think, per the presentation this morning, there is a limited amount of options available right now. The best investors right now are the strategic type investors, the investors who have a real significant interest in the transaction. So for example, we're doing one right now. We just closed another one where they're both health sciences deals. One's called Jet Acquisition Corp. They have a $75 million commitment from a strategic investor. We did another one called Health Sciences Acquisition Corp. Even in this market, they had a $50 million commitment from a strategic investor. So this is, these are strategics that are lined up like the target, not as dependent upon these pipe numbers that we're seeing decreasing and so forth. I think the other half of your question is what do you stay away from? And I think that there's a lot of misunderstanding with regard to the ELOC, the equity line of credit. I'm not a big fan of the ELOC personally. I know that goes against, what other people are sort of bantering about. What I've seen is that, again, a lot of it depends on how this company is going to trade following the merger. But what we have seen just out of experience, right? Because theoretically, if the merger goes well and there's a lot of volume and there's an ELOC, they could theoretically just continue to take money down. In practice, what we've seen with a lot of deals is there wasn't sufficient volume to be able to absorb money coming from the ELOC. And so what was originally considered to be the targets thought they were getting like $100 million off the ELOC term sheet turned out to be drastically less than that. I think I'd be very skeptical about the ELOC, recognize the fact that this is not the solution to the problem, number one. Number two, in the absence of a strategic investment and trying to do even some sort of a pipe that's not a fixed pipe, you really have to take a very careful look at the floating terms of a convertible pipe. These things can ratchet with no floor, and in this type of market, you sort of have to be very careful about what you're being offered.
But if in the absence of any other financing, for example, would not an ELOC be a good way to put some comfort into the target company that in the event that they need to draw on something, that there's a facility?
So you're asking an honest question. I'm just trying to give you an honest answer, right? I think that a lot of targets are somewhat misled about what an ELOC is in practice. I think what happens with a lot of sort of unsophisticated targets is that they see a term sheet with the number $100 million on there, and they're like, well, wow, I got a facility I can start taking down like $100 million. In practice, if you actually did the analytics, which I don't have in front of me, and you actually look how much was taken down off of these ELOCs, significantly less.
So what you're saying is then that really the cost of capital of that ELOC is really high.
I personally believe, and Alex on the on this panel, you can speak to that. Tony, you feel free to kick in, but it's just my experience. Best thing that can happen to these targets is say, okay, close the deal with whatever they're at, and go file an S1 or an F1, depending if they're foreign or domestic, and then just do a follow-on offering. Do the price, rip the Band-Aid off, one shot, know what your price is or whatever. Problem with an ELOC is it's like an overhang, right? You're going to have to take it down in pieces over the course of 2 years. The market sees that there's this overhang, and you're very dependent upon the volume. Whereas if you can do an S1 or an F1, 60 days after the SPAC merger or something along those timetables, you know what your price is, you know where it is, you've raised your capital, you've got a dedicated public base that you can work from and deal with that right after. But that's just my view, my experience. But obviously, you guys, Tony, Alex, feel free to.
Yeah, I would echo to Mitch's comments. I think in totality, there's a lot of constraints attached to ELOC. For example, there's certain equity condition you have to meet in order to use it. And also, you need to have a certain amount of trading volume to absorb the ELOC. And the way the ELOC works is it's typically you use a VWAP as a reference price. And on top of that, there's a discount attached to it. So it's almost, in a way, it creates a death barrel, right? If you keep on using it and selling it into the market. So it's somewhat a toxic financial instrument. So the overall, if you add up all the the implicit cost to it, it's actually very, very costly compared to other financing tools.
100% agree that I'm not a big fan of ELOC, and I just want to share some real life experience regarding ELOCs. We actually had the opportunity to meet some potential target companies. When they started, they don't even have an audited financial. But they already have a committed ELOC of 100 million. You know that means there's something wrong with that.
Well, banks make a lot of money with issuing the ELOCs, right? And ELOCs are equity lines of credit. Then maybe for Alex and you, Tony. So given what you said, there are a lot of post de-SPACs. A lot of these company shares have traded down, right? Of course, in the Singapore context, everyone knows the Grab example, right? What are the lessons learned from these broken deals?
I mean, to me, it's really how do you define broken deals? Some deals that if we just look at a broken deal, is for deals that the stock has dropped significantly post the merger, particularly during the first 6 months. In some cases, we see stock come down from 10 to even 2, sometimes even below than 2 within 3 months. Those deals, if you look at it more carefully, very often the case that they may have an unrealistically high valuation, and their pipe structure may really set up for failure from the beginning. And to a certain extent, some companies post the merger, the stock didn't perform well. It is also because the companies failed to deliver as a public company on the operation side. And often there's another perspective of that very often the business has a very attractive story, and you really find that when the company have someone, most of the cases as the CFO or the public market face, that when they talk to investors, particularly institutional investors or research analysts, they cannot tell the story in a very convincing way. That said, I think that's very well covered by Crocker earlier today, that a lot of companies was lucky enough to go through the de-SPAC process, but they are technically not ready to be a public company, to the bare minimum that a lot of companies, I think, not very prepared or to be not have a very qualified, very well qualified management team to run as a public company. Like in terms of investor relationship. You may don't even have an IR program yet, and you may find an IR partner that's, in my personal opinion, not very well qualified. So that's very, if we put all those factors together, that's naturally lead to broken deals. I won't necessarily, blame that SPAC as a vehicle, like Mitch mentioned earlier today. SPAC is just a vehicle, a ticket for the company to go public. And if the deal was properly structured, the valuation was properly done, and if the management is supposed to do it as a public company, and there shouldn't be any different than a traditional IPO.
Well then, Mitch, do you see any significant changes in terms of the deal structures, the deal target and SPAC management to kind of align their interests, such as the earnouts or make goods, or and then should the SPAC management join the board or
all that
or not? Yeah.
Yeah, so let me comment a little bit first on what Tony said, because I think he was touching on some important things when it comes down to the decrease in stock price. I think what you're seeing here is a little bit of phenomena where the public is sitting back and they're taking a look at like the 8K and how these deals get announced. And when they see that there's no pipe and there's no following and there's absolutely no support to the deal, they're making the bet that the price is just going to go down, right? Because no one invested in this thing, they had no support, maybe it was overpriced in terms of the merger agreement. So what you're seeing is people just sort of putting out shorts on these things at like the $10, the $9, because they're seeing that this thing is going to start decreasing in price. That is a very good trade today. It's going to be a very dangerous trade if the market starts going the other way and we start seeing money come back into the vehicle. But that's part of the self-fulfilling prophecy that we're seeing in terms of the SPAC mergers right now. But just because it goes down in price doesn't mean it's a broken deal, right? Those are two very, very important things. It's just a product. A broken deal is one where, just like it's sort of like you have a deal that sort of closes into the SPAC, but they really can't get an operating company or a public company going. That's very different than like a deal that's good company. It's just price just goes down. So to your question with regard to what we're seeing in terms of structures, earnouts have always been a very common mechanism to be able to get to a certain valuation, to also embed some sort of transparency into how they expect this company to perform going forward. Earnouts have always been a mechanism. I think what you're seeing now as well is, per what we discussed earlier, when we're seeing targets that have the option to see which sort of SPACs they can negotiate with, they're imposing that same sort of mechanism upon the sponsors as well. So you don't just have an earnout from the target's company's perspective in terms of the number of shares that they get. They're sort of negotiating some of them that the sponsors are subject to the same thing. So if certain, if they're not performing quite as expected, that the SPAC management team would also forfeit some percentage of their shares.
But why would the SPAC management team be responsible outside of their control?
Well, that's something that they could certainly negotiate, right? But at the end of the day, this is part of the dynamics of the negotiation, right? A lot of times the target is sort of saying, look, we're going to want the sponsors to sort of share in, as partners in this, in the performance of this going forward. And we basically want to be able to show the market that that the sponsors' interests are aligned with the transaction. So when you go out to investors or on a roadshow or whatever, the sponsors are basically, in addition to the earnout, the sponsors are also able to go to investors and say, listen, we've done due diligence on this company, we've looked at this company, all of that stuff. We're actually putting some of our shares up at stake as well. So if we don't accomplish what we believe that that it's not performing as we expect, we're going to forfeit shares too, to send a stronger message to the marketplace that that this company could do what it says it can do.
Eddie, so one of the worst things a company can do to undermine investor confidence is late reporting, right? Quarterly financials. So, you know, if you're a listed company, what should the management teams do to make sure that they're ready from an accounting perspective, you know, to, especially when they become public?
This is a great question. So when a private company, basically the target company, finished the de-SPAC, it became a public company. So basically the management, I would say the CEO and the CFOs of the company should be responsible for the financial reporting to make sure the quarterly and also the annual financial statements are filed timely. And they are responsible under the corporate governance, under the SOX rule, that they have to be responsible for the accuracy and the completeness of the financial statement. So under the law, they signed the Section 302 and the 906 that they are responsible. So if their accounting team is not capable of doing something like this, they should really go out and hire a US GAAP consultant to help them to make sure that the financial statement and the 10Ks and the 10Q are reported timely. Otherwise, that the investor is going to go after you on that. So, I mean, you know, I don't know how many CFOs and CEOs in the audience, they should be aware that, you know, after the company is public, they are responsible for the financial reporting. Like Drew said before, that it will be a big leap and a big gap to fill when a private company becomes a public company in that sense.
But also, I think, would it also prudent to kind of manage the first 2 quarters of, you know, results as a public company, seeing that you want to rely on, you know, longer-term forecasts in terms of your projections to meet your first quarters? Does that have a bearing on credibility?
Well, when the company had their first and second quarter actual numbers, you know, in place, the internal management or the financial team should be able to have a pretty good handle of where the business is heading to, and in terms of forecasts. So I think that also the CFO of the company and the CEO of the company should be responsible for the company's the projected numbers, you know, in the future, how they project their forecast of the business, where they're going from there.
That's useful. Hey, Hiren, no, sorry, I didn't mean to leave you out, but you get the easiest of the questions because NASDAQ has been the listing venue for, I guess, the lion's share of all the SPACs. And there have been some high-profile listings here in Southeast Asia. So what do you think of the opportunity? How well do you think Asia is, or Southeast Asia is well understood by US investors? And what is NASDAQ doing to improve that?
Okay, so the US investors and one of the smartest investors out there, they get the ability and access to, for the local markets here. So Southeast Asia has been the right of the activity, and US investors get the access to invest here. That's number one. Our top recommendation to issuers is that they should really set up their internal controls very well and start behaving like a public listed company much before they're public, right? So which also means that they should start reporting on the quarterly basis so that when they move to become a public listed company, it becomes a natural habit, right? Because as you know, markets can be very unforgiving. Because you got to report as a public listed company when you announce your earnings date. So that's, I guess, the top recommendation that we provide to the companies. What is NASDAQ doing? We do see Southeast Asia as ripe for the IPO activity. close to 208 F1 and active F1 and S1 filings globally, out of which about 90 are in the APAC region, about 40 of them in the ASEAN and India region. So there's a lot of activity. We see a very good pipeline of IPOs coming to NASDAQ this year or next. So yeah, that's the sort of, and again, we'll talk a bit about how NASDAQ is helping companies locally in Singapore in a bit. Yeah.
Maybe should some of these companies act more like IPO type companies where you have pre-deal research, post-deal research, hire a very good, competent PR company that really can navigate and you know, Wall Street and the investors, as well as, you know, making sure all these investors know where all these countries in Southeast Asia are as well, right?
Yes, I think the prime role of a company is to look for long-term value investors. That's the goal of IR, and I guess to just have a formal, efficient IR program is a definite must for any public listed company. Having a good CFO and investing into a good CFO is also highly recommended. So again, each region is very different here. Singapore is very different to Malaysia or Vietnam. So the IR needs to understand the local market very well, needs to tell the story and communicate it very well. But as Eddie was mentioning, that the first 2 quarters of the company are super important because if you win the trust of your investors in the first 2 quarters, then it's a bit of a smooth sailing from there on. But if you don't promise if you don't deliver what you've promised in the first 2 quarters, it's very difficult to win back the trust. So it's a role of an IR and the CFO to really communicate that story outside.
I mean, what's your view about the fact that maybe from an SEC perspective as well, about China and, you know, and the US, and now the attention is obviously on Southeast Asia, right? Do you think this is sustainable given the size and number of deals here, or when, you know, the North becomes active again, Southeast Asia could be relegated to second spot again? Or you think that this is hopefully the start continuing of, you know, a further momentum of the business?
Yes, I think 700 million people in Southeast Asia. There's so many unicorns coming out every day. There's so many local businesses. Entrepreneurship is a global phenomena. It's not only in US, it's in Southeast Asia, it's in Malaysia, Indonesia, Vietnam. There's successful businesses all around. Obviously, a lot of money has moved from North Asia to Southeast Asia for whatever reason that is in the last couple of years. But personally, I do see the trend ongoing where the companies need access to global capital, the deepest liquidity market. And US is the gold standard for reporting as well. So it's all pointing to the right direction. And just to answer your question very direct, definitely we do see this trend continuing in the next foreseeable years.
Eddie,
Yep.
What do you think is the greatest misconception among the management teams about becoming a public company via SPAC merger? And then how would you advise them about committing to this path with, I guess, both the plus and minuses and the challenges?
Well, the biggest challenge is really that the CEO and the CFO, they have to transition themselves from a private company role to a public company because there are a lot of rules that they have to meet to comply with the regulator, such as the SEC rules and also the NASDAQ rules. And they also have to get used to, have a board meeting to make sure that all the major and significant decisions made internally, not just by the CEO and the CFO. Right now they are a public company. They are under the board management, not the CEO. A lot of the private companies is still running the shop like what they were before. after they become a public company. So the CEO is no longer the king, and they have to, answer to the board of directors.
Not easy to do.
No, not easy. I mean, you were the king, and you always think you were the king. So they have to make a transition that, that you have an independent board. You have to let the members know all these significant events going on with the company. So if you make a mistake and you skip over the board and you make a wrong decision, it could be a disaster in that sense.
Well, I think let's try and finish on a more positive note, right? 2022 was a really tough year for many former SPACs, but we're actually seeing a nice bump in the stock price during, the beginnings of 2023. Maybe to all of you, what do you think is required to see more SPACs trading, post-merger up and making this a really attractive asset class?
Get the interest rate down, so so you can create liquidity, because right now it's really not a bull market; it's really a bond market. Now, you see, the Fed has to do something to ease up the interest, and they're trying. On one hand, they're trying to fight the inflation. On the other hand, is hey, why is the stock market is performing so poorly? So I don't know. I expect that the Fed is going to raise another quarter point, in the very near future. But getting the interest rate down is really the key right now to create liquidity. Right now, we are all locked in by the interest rate.
Well, I mean, with the IPO market shut, the SPAC market is still the most viable option, right?
Right, but you still need the pipe to support it. If you have like 95% redemption rate, you can close the deal.
You can with an ELOC, but it'll just cost you.
well, Mitch said it's really toxic, that ELOC. So you could, you can have all kind of different financial instruments, like forward contracts to close the deal, but it's a derivative. It would not.
So you have a backstop, you have a forward purchase.
Okay, so all these are toxic, I call it derivatives, financial instrument. Is not going to be good for the company in the future. It would hit your bottom line, sooner or later, and you're going to have like phantom losses that is going to be a disaster. That's only my point of view, not necessarily the Marcum point of view, but so.
So I would say you need to have a long-term view to being a public company. I think completing a de-SPAC is just the first step of being a public company. You have to focus on executing a business plan, delivering results, maintain proper communication to the market, etc. I think in addition, there are also structural elements where you can improve upon in connection with the de-SPAC deal. If, for example, you can clean up some of the overhangs associated with the rights and warrants. We as the Maxim, being the underwriter and advisor, can certainly facilitate that. Between willing buyer and willing seller. In the grand scheme of things, I don't think it costs a lot, right, to buy back some of the rights and warrants. So it will go a long way post the de-SPAC in terms of maintaining order trading.
So you're saying to reduce like the overhang, you would kind of recommend looking at the warrants, rights issues and trying to resolve that, taking it off the balance sheet.
Yeah, absolutely. It's a privately negotiated deal with with the seller. So the rights are typically trading at between 10 to 20 warrants along the same line. So it doesn't really cost a lot to clean some of those up.
I think few factors which are affecting the market. One is the uncertainty as to which way the inflation will go, how will the interest rates go up. And I think what we need is really to have 2 or 3 companies go out there and do well. I think that just gets some confidence to other companies to go out, especially from this region. If we have those success stories to share, I think that may be a bit of a twist to the story here. What we look at is maybe end of Q2, Q3 is when things will probably start to look up. But it also depends on the macroeconomic factors, obviously. But also, I think a lot of focus will be on the corporate earnings going forward. So how does the Q2 and Q3 results shape up? Market is obviously looking very closely at profitability or near profitability. So I think that will gain a lot more importance in this high interest rate environment. So I think it'll be interesting to see how Q2, Q3 shapes up. But the pipeline is very strong. There are as many active S1, F1 filings at the moment as we had at the same time last year. So there's definitely robust activity, and the market is waiting for some companies to go out and do that.
So I think it goes either, there's 2 ways that the SPAC product works, right? We're seeing how it reacts in a high interest rate environment, which is it's essentially the only game in town because you don't see IPOs. And so you're going to get deals, companies that are saying, we got to move, we got to keep moving. We can't wait a year, 2 years. We don't know when things are going to change. We don't know what's going to happen, how it's going to price. I'm going to look at this as a 2-step approach, get my SPAC merger done, number 1. And then I'll raise more money, number 2. That's where we will continue to be if we're in this like high interest rate environment. If we start moving into a low interest rate environment, I don't know, could be second half of this year. Who knows? Could be next year. Nobody knows, right? Everyone talks. Very few people know. If that actually happens and we see asset values increases, which usually what happens in a low interest rate environment, we have a chance of seeing these stocks break above the $10 number. When it breaks above that, we start seeing redemptions go down. We start seeing pipes pick up. Either way, SPACs will continue. It's just 2 different games. I think what also happens over the course of this year is we have less SPACs that are out there. In other words, less inventory, which in other words, the market looks at, there's a lower risk of liquidations because there's less SPACs, and more companies. And so with that, you start seeing somewhat higher warrant prices because you're not as worried about them liquidating. So warrant prices could creep up. All those things will just play out over the next 12 months.
To me, it's all about credibility, and credibility. And once you become public, either you're through a traditional IPO or de-SPAC or reverse merger, it really makes no difference. By the time the company becomes public, it's really, in a small micro cap world, no company is perfect. You have problems, you have issues here and there. You're not perfect. Investors look at you, analysts look at you. They know that you are not perfect. But once you become public, you should take time. Often that time frame can be 3 years, 5 years. Take time to improve day by day, year by year. Eventually, you will gain investor trust, and you will have more institutional ownership. You will have research coverage, and it will pay off. We all know, I think very often we talk about being public do give you the ability to print money. Print money, not necessarily print money. It comes with a cost, and it takes a lot on credibility. And I think as a public company, my piece of advice for every public company is really, whatever you do in the capital market, before you pull the trigger, think twice. What will affect your existing shareholder? What affect your future options in the capital market?
So I think we had some great advice from our panelists here. So I hope all of you will join Eddie and Mitch in their letter they're going to send to the Federal Reserve to reverse their current stance on interest rates so we can have a better performance. I certainly agree with Alex that to the extent we can clean up the cap structure on these companies, that would be a positive. move, and with Hiren, there's no arguing that success breeds success, and all it takes is a few companies to really break through and start to trade in a meaningful way above trust, and then suddenly investors are going to take a second look because it's no longer a one-way bet, which Mitch made very clear. Right now, this is a pretty safe one-way bet for the shorts, and if we change that mentality, then people are going to have to start looking more seriously at fundamentals again. And then I think Tony's advice is great, which is hey, this is your company. You're going to get really one shot at going public. You got to really think through what the right path is. And it's a lot harder to fix these issues later than it is to get it right the first time. So I want to thank all our panelists, our last panel, and I hope we give them a great round of applause. And a round of applause for our audience for sticking with us all day. And thank you guys so much. And we hope to see some of you later this evening at our after party. Thank you.